Hi, this is Mr. Mortgage. It's July 17th, and today we're going to talk about a very serious issue, one that is affecting banks like IndyMac, Countrywide, WAMU, Wachovia, Downey Savings, First Federal, Bank United, even Lehman, Bear, and Deutsche Bank to some degree. And that's the morbid toxicity of a loan program that was very popular in the bubble years called the pay option arm or negative amortization loan, or for those of you who do not like the negative connotation to negative amortization, then you can call it a cash flow arm. All those names were used to describe this loan program, and I believe that this loan program will be responsible for round 2 of the mortgage implosion. I see the data, I see the defaults on this loan program absolutely surging right now, while subprime defaults are actually have plateaued and start to ease off a little. These are absolutely surging. I'm going to explain why. They talked about this on Bubble Vision the other day. The Treasury was on with the Fed, and look at the look they got in their faces. Yeah, they were talking about the pay option arm at that point in time, I swear. No, actually, that's just from Misha's Global Economic Trends. It was a great picture. I thought I'd show it to you. When you go onto my site, which is located here, at ml-implode.com, the original mortgage lender implodometer. Click on that banner with my head on it. That takes you to my site where all the fun, action, and partying is. Make sure you put in your email address so you can get everything I do on a daily basis emailed to you. So the pay option arm, the banks that I mentioned did the most of them, and what do they all have in common? They're all in the headlines every single day. And those headlines and those same problems are moving quickly onto the consumer. But we still have time, I believe, to get ahead of this problem. Defaults are surging with this program type. But there is, I believe, still some time before this body slams the housing market in the bubble states where this is most prevalent. Pay option arms are a subset of the Alt-A universe. There's about 230,000 of them in the state of California and 450,000 of them nationally. Again, Alt-A loans and the Alt-A universe make up, are about 50% larger than the subprime universe, and the loan amounts are a lot larger. Average is about $400,000. So really, this could be about a $1.6 trillion problem. Just the pay option part of the Alt-A universe, which is only 33% of the Alt-A universe. So this is a big problem we're talking about. This is larger than the subprime problem, just the pay option problem. So again, we need to get a hold of this. I'm going to refer to my notes here because we have a lot to talk about. World Savings created this program about 25 years ago. World Savings, as you know, Wachovia bought them a couple years ago for about $26 billion, and ever since then, their problems have increased and increased. We saw Wachovia doing commercials just 2 months ago, which I thought was very irresponsible, on the pay option arm with families dancing around the living room because they had payment choices. That is this program. Typically, this program comes with about 5 payment choices. The first is a minimum monthly payment, and that is based on whatever you choose, and it's typically 1 to 3% depending on the lender and which variation of the program you choose, and that's a fully amortized payment rate. They give you also a 30-year payment choice, a 15-year fixed payment choice, a 40-year fixed payment choice, and an interest-only payment choice. Now, the differential between the minimum monthly payment of 1%, let's say, which 80% of borrowers choose to pay because it's the cheapest, and the interest-only payment is called deferred interest or negative amortization, and that gets tacked on to your balance so your balance grows. Even subprime loans, the balance didn't grow, guys. That's what makes these things so much more toxic. When borrowers get upside down, they can't get out of this loan program. Again, 80% of these loans programs, the borrowers make the minimum monthly payment, and that is key. Values are down so far. Values are down in California 30% in the last 12 months. We know the average LTV at the time of origination on most pay option arms was about 90%. That means just because of values dropping, they're upside down 20%. Then you tack on the negative amortization, which can rack up at the rate of 4 to 7 or 8% per year. And these guys could be upside down just because of that, 30, 40% in most cases. You can't refinance, you can't sell your home, right? What are you going to do? You wait until another feature of this loan kicks in called a maximum negative amortization allowance of 110%, 115%, or 125%. And when your loan reaches that, for example, you have a $100,000 loan, when you reach $110,000 because of negative amortization, they send you a letter saying you have to refi, you have to sell, or you have to make the minimum of a fully indexed payment that'll enable you to pay off the loan in the remaining term, which can be a double. People's payments literally can double or more when they get that letter. And at that point, they have no choice but to walk away from their home. And that's what we're seeing. Why would you want to double your payment on a loan you've been paying on for a year, 2 years, 3 years on an asset that's down 50%? We're seeing people absolutely walk away from these homes. Most of these came with 1 to 3 year prepay. So even borrowers who knew that this was going to be a problem could not get out of these things. People that took this loan a year and a half ago who had the time to get out couldn't get out because they would have had to write their lender a check for $20,000 to $40,000. They were stuck in these loan programs. People loved this loan program. Actually, the banks loved this loan program for a little known accounting irregularity called capitalized interest on negative amortization, or CINA, or deferred interest income. If on a $750,000 pay option arm, if you paid the 1% payment rate, your payment's about $2,400 a month. But let's say the interest only payment was $4,500 a month. That difference, the fully indexed rate was $5,500 a month, or $5,000 a month, my bad. That difference in that, the banks actually get to book as income, as revenue, even though they never got it. It's phantom income. And it was very obvious that that CINA was rising at all the banks, quarters ago, 4 or 5 quarters ago. It was rising. That's because people were paying the minimum monthly payment and the banks were living off of phantom income. Indy Mac did not fail because Schumer said something about them, because they made bad decisions. They had too many pay option arms in the books and too much of their revenue was phantom revenue. And it's all in their quarterlies to see. The OTS fell asleep at the wheel and did not know how to read quarterly and annual returns. So all the banks that specialized in these have massive earnings restatements coming where they have to back out all that phantom income when they foreclose, because the theory is when they foreclose, they get it all back. But no, when they foreclose, they get 50 cents on the dollar, in the state of California at least, on homes. So not only do they take that loss, they have to back out all the income that they ever posted on that loan in the first place. They did these loans to 100% loan to value. They did them stated income. As a matter of fact, E-Trade was the largest purchaser, bulk purchaser of second mortgages behind negative amortization first, because they didn't ask on their tape whether the first mortgage was a neg am or not. So they were the dumping grounds for it. In April of 2007, a friend showed me the queue, and they had $22 billion worth of seconds. We all knew that was behind neg ams. Look what happened to them. Neg ams have taken down company after company after company, and now they're getting ready to take down the consumer. American Home Loans, if you remember, mid last year was the first company that was loaded up with these things that got taken down because of neg ams. Again, the banks loved it because a more prime borrower would have an effective interest rate of 8 or 9%, and even though the borrower made a payment of $2,400, they got to book $6,000 in revenue. That's why the banks love these, and why this was allowed for so long, and why the regulators didn't catch up on it is beyond me. But now we have banks in peril all over the nation because of this loan program, and it's bleeding over the consumer right now, and defaults are spiking. We have time to get ahead of this, and all we can hear about is a Dodd $300 billion bailout. If you're a consumer with one of these loans, you're likely heavily underwater. Yeah, likely don't know what to do, and you're zooming in on that 110, 115, or 125 where you hard reset. There are options. I did a video on mortgage modifications. You need to watch that. I featured a company called Green Credit Solutions, or getgreencredit.com. They're doing wonderful modifications for people. They're wiping out all your neg am. They're having houses reappraised to current value and bringing principal balances down to like 90, 95% of that. They're wiping out second mortgages. They're doing a real good job. It's all free, the consultation, not the service, but the consultation's free, and they'll give you all your choices if you're in one of these toxic loans. But the longer you wait, the harder it is going to be to get out of one of these things, especially if they put new laws in place that'll make you partners with the United States government on any upside. So you need to check that out. It's on my site. You'll see a banner says Green Credit Solutions on it. If you like this video, guys, please rate it high. I still work for stars. Please subscribe to this YouTube channel by hitting subscribe at the bottom. Also subscribe to my blog by putting your email address in, and that at the end of the day, that sends you everything I've done on the blog for the day. And by all means, don't believe the hype.